financial choice we make drains our energy. When we run out of mental bandwidth, we tend to put things on autopilot. The problem is, we usually automate the wrong things. We blindly trust systems designed to extract our money, and we overcomplicate the ones designed to grow it. Look at the two environments where most of our net worth is decided: the car dealership, where we take on debt, and the stock market, where we build equity. Financial institutions know we get tired. They build complex transactions that bundle different products together, making it nearly impossible to see exactly what you are paying for or where your money is actually going. This quadrant chart plots out where we should actually spend our mental energy. It maps the effort you put into a financial choice on the bottom axis against the actual financial impact on the side. Sitting across from a car dealer and arguing line by line over a trade-in value is exhausting. But the payoff is keeping thousands of your own dollars from vanishing into a bad loan. Staring at stock charts and trying to time the market is just as exhausting, but it usually loses you money. Meanwhile, setting up a system that just buys investments in the background takes 10 minutes and drives long-term wealth. When we mix these up, when we get passive at the dealership and hyperactive in our brokerage accounts, we lock ourselves into hidden debt and miss out on years of compounding growth. Walk into a dealership, and you are stepping into a system engineered to wear you down. They don't sell you a car, a trade-in, and a loan as 3 separate items. They melt them into one confusing package. The entire negotiation is usually steered toward a single question: what do you want your monthly payment to be? Once you agree to that payment, the dealer can shift the price of your trade-in, the cost of the new car, and the interest rate in the background without you noticing. This split-screen flowchart shows the math moving. The dealer shrinks your trade-in value by $2,000 for a low monthly payment, making profit through worse interest rates. Old car debt rolls right into the new principal, leaving you underwater. Beating this system requires you to intentionally cause some friction. You have to force the dealer to unbundle the transaction. First, you negotiate the exact cash value of your trade-in. You do not discuss the new car, and you do not discuss financing until that trade-in number is locked in writing. Next, you bring in outside financing from a bank or credit union before you ever step into the dealership's finance office. The salesperson will push back, but enduring an awkward conversation exposes the true math, protecting you from hidden double charges. Once you've protected your downside, you have to build your upside. In the stock market, mechanical consistency consistently outperforms human emotion. An automatic investment plan, or AIP, is a strict strategy deducting a set amount from your bank, invested at regular intervals. It completely ignores what the market is doing that day. The math powering this is called dollar cost averaging. This line graph tracks a volatile index over 5 years. Because you invest the exact dollar amount every period, the system buys more shares when prices drop. Over a decade, your purchase price smooths out, removing the need to guess. The biggest advantage here is behavioral. When markets crash, human instinct tells us to stop buying. An AIP takes your hands off the steering wheel, forcing you to buy assets exactly when they are cheapest. It trains you to ignore the temporary noise that usually triggers retail investors to panic and sell, like sudden headlines about crude oil prices, or speculation about what the Federal Reserve is going to do with interest rates next month. The autopilot just quietly keeps buying. If you have a 401k at work, you are already using a pre-tax version of this exact system. A percentage of your paycheck is invested before you ever see it. The trade-off is that this requires patience. Dollar cost averaging only softens volatility if you stay in the market for 5, 10, or 20 years. And it will not save you if you pick a terrible fund to begin with. An AIP is a behavioral defense mechanism. It lets compounding time do the heavy lifting while sidelining your emotions. To build wealth efficiently, you have to split your approach. You must actively dismantle the financial traps at the dealership and passively fold your hands when it comes to the stock market. Here is a side-by-side roadmap to apply this dual strategy right now. If you are tight on time, set up your AIP today. Link your bank, pick a broad index fund, set the dollar amount, and automate it. That immediately frees you from the burden of daily chart watching. Take the mental bandwidth you just saved and actively reallocate it to fighting the unbundling battle the next time you buy a car. If you treat your automated investments like a short-term trading account by demanding rapid gains, you break the math that makes the strategy work. Without a 5 to 10-year runway, dollar cost averaging simply does not have the time it needs to absorb market drops. On the flip side, if you walk into a dealership and refuse to engage in a little social friction, you are volunteering to absorb negative equity just to keep the afternoon comfortable. True financial architecture means knowing exactly when to deploy active vigilance against debt traps and exactly when to let the machines handle your growth.